All right, good afternoon. Let's begin. Your next homework assignment is due on Wednesday, and then a week from today, we're going to have our first quiz. The coverage is listed there and so on. Any questions related to these announcements? Now, everybody knows we're not going to have class on Monday, right? All right. Hopefully there won't be anybody sitting here all solitary and lonesome wondering why we're not talking about engineering economy. Hopefully you've got something good planned for the weekend. But I will see you again on Wednesday when that homework's due. So I also won't be having office hours on Monday because it's a holiday. So if you have questions, you can send me an email, or you can stop by my office hours this afternoon or on Tuesday. I'll also have office hours on Tuesday before the assignment's due on Wednesday. So, okay. We're looking at a graph here, and on the horizontal axis is the amount of money you want to borrow from a bank. On the vertical axis is the interest rate that the bank is charging. So let me ask you this. Why would the interest rate go up as the size of the loan increases? It's a bigger risk for the bank. Why is it a bigger risk for them? It's still you know, like if you own a business, maybe you finish concrete and you want to buy some new materials for your business. Why is it more risky for the bank to loan you $6 million compared to loan you $3 million? It's still the same client with the same credit score. Why is it more risky? Okay, yeah, because your repayment is going to be larger, and so it's more challenging for you to repay the amount. So when you build a new building like the one that we're in, the larger the building that's completed, the more risky it is that you can't utilize the space and make a good return on investment. And so what this graph is showing is that I think everyone kind of understands the reasoning for it. Borrowing costs go up with the size of the loan. So if you wanted to get a loan, it's first of all going to be a yes or no kind of a situation. If the bank may not loan money to some people regardless of what they're willing to pay on the interest rate. But as risk goes up, so does the bank's appetite for an increasing return on the capital that they're loaning to you. So let's say that you have a company or that you work for one, and you've got lots of ideas of how you could use some extra money. You need more money than you've got because you'd like to invest in some of these things, maybe all of them. If you could get enough money, you could upgrade your computer network, hire some new people, provide laptops to everyone. So there's this list of projects that you could do. When you have a list like this, you need to sort it and start asking how much would each of these things cost, and what kind of a return on that investment are you likely to see? So let's say that it's easy to estimate those things. Cost, you can get someone in the purchasing department to get quotations from vendors, or someone in human resources to tell you what the new employee costs are going to be. Let's assume that you can find out how much of your ideas, what the cost is for each of them, and you put them in order, chronological order, so that A is the most expensive thing, and G is the cheapest. And the reason why we're thinking like this, we're going to superimpose these possibilities on top of the graph that we were just looking at previously. We're going to put two things together, two elements of the figure. The second question, though, what is the return on investment? That's only going to be something you can estimate. You never know exactly in the future how much additional revenue you're going to get for providing new laptops to your salespeople. I mean, maybe they have really bad laptops right now and they can't send out emails as well to clients, or maybe they have a hard time presenting the software demonstration to the clients that you'd like to do. So you don't know how much that's going to translate into additional income for your company. But let's just say, for purpose of illustration, that that's something you can know in advance. Okay, so here's that combination. Each of these letters represents the project we were just talking about on the previous slide. So each of these A, B, C, D, the height of that bar represents the return you're going to get for making the investment. The width of the bar represents how expensive it is. So it looks like project A costs about $600,000 because it goes from 0 to 0.6 million. So the width of these, it looks like alternative C is the most expensive out of all the projects. How do I know that C is the most expensive? It's the widest. Which project has the highest return on investment? It's this first one, A. So it's not coincidental. I ordered them. I labeled that project A because it was the one that had the highest return on investment. Okay, so everyone understands what these bars mean. And you remember from our earlier discussion what's happening with the blue line. Now what we have to do is look at the two things in reference to one another. So project A, should you do it? Should you do project A? I see some people nodding their head. Why should you do project A? For less money you'll get more return. Go into more details. What do you mean specifically about that?
Well, by investing what looks like less than $1 million,
okay.
You're going to get 35% return.
You're going to get 35% return for that project. You're going to have to invest some money. Where's the money coming from that you are investing? What's that? A loan? Okay. So what is the bank charging you for that money? What percent do they want to be repaid for that $600,000 that you borrow for project A? How much percent? Like about 10%. So what you're telling me is there are banks out there who will give you money and they only want 10%, but then you can invest it someplace that it's getting 35%. You should definitely do that. Let's say, what if there was one bank that would loan you $1 million for 10%, and you could take it to the next bank down the street and they'd pay you 35% to deposit that? You should do as much of that as you possibly can. Don't stop at $600,000. Take out the biggest loan you can possibly get from that first bank and deposit it in the second bank. That's the rule. Maximize your profits. Every last dollar. And so what about project B? Should we do project B? What's the rule? If you see a trend developing, what's the rule? Okay, if the height's above the blue line. In other words, if you have a higher return than borrowing costs, thumbs up on the project. So this is the first illustration of project selection that we're going to do. Through the semester, there's going to be lots of ways we analyze whether we should do a project or not do a project. And the first criteria that you should ask yourself is, will it be profitable? Your project won't be profitable if the borrowing costs are higher than the return on investment. So we should do project A, we should do project B. But wait a minute, let me play the devil's advocate for a moment. Why would I want to do project B? It has a lower return than project A. Okay, it's a lower percent return, but maybe the overall profit is even larger. Look at the area under the curve. It's the area under the curve that tells you the number of dollars that you're getting back. And so even though 35 is lower than 30, if you could only pick one project, I'd pick project B. Because even though my percentage return is lower, the investment amount is larger, so I'd be getting more dollars, even though it's a lower percentage rate. We're going to come back to that particular idea several times later. So it's not important if that's still a little bit fuzzy for you. Don't worry about it now. But it doesn't matter that the return is getting lower. You shouldn't insist on every project having 35%. Maybe you just don't have that many good ideas. You know, not every project is going to be that good. They call it the low-hanging fruit. You pick the low-hanging fruit, and then you get a ladder, and you pick the fruit that's higher on the tree, and then the last fruit you pick is at the top because it's really hard to get to. And so project F, we're going to reject project F. Why should we reject it? At that point, what's happening? We're not making money. Our cumulative borrowing costs, because the bank, they have been adding up how much they've loaned us to date. And as our total cumulative loan amount goes up higher and higher, they start getting a little nervous and they're ramping up the interest rate. And so by project F, the bank is thinking, wow, these guys have really, maybe they're starting to bite off more than they can chew. Let's raise the interest rate on them. 16%. Well, project F only gives us 16%. And so don't do a project where your borrowing costs equal the rate of return, because it's like you're doing all that work for nothing. You know, it's barely breaking even. So only do the things that you have a positive return for. And project G, obviously, we should reject, because at that point, it's not even a break-even project. You're losing money for project G. So does anybody have questions so far about the illustration that is, yeah? Good question. Right. So the question is there ever a case we should do project F? Yes. What if project A, we were all set to do it, but then the county pulled our permits? So we can't do project A anymore. So what that does, if project A is no longer an option, it shifts everything to the left. And so what it means is that the borrowing costs for project F are now going to be lower than 16%, which is its return on investment. So project F maybe would have been a fine project if that was the best idea that we had, or if our other ideas aren't so good that it's being crowded out. Thank you for asking, because that's a really important point, that even project G would look good to us. Like, let's go back to the bank example. Would you borrow money at 10% if you could deposit it somewhere else for 14? Sure, absolutely. If any time the borrowing costs are lower than the return, then you should do it. But it's just that project F and G are being crowded out of the possibilities because we have so many other great alternatives right now. Does that answer your question? Okay. Last semester that I taught this, the students asked me, well, why not just turn it the other way around? Why not go G, F, E, D, C, and so on, and then it would always be higher than the blue line? And that actually, you can't do that. This sort of a diagram, you have to have your best project first, because if you sorted it the other way around, eventually you add up all of the money, you're going to be exceeding the total cumulative borrowing costs are going to outweigh the return on the investment for F and G is going to be lower than the borrowing costs, regardless of how you sort it. It's just like this sort of a visual representation helping you to make the decision. It should always be from high return to low return. So you can't flip it and defy the laws of finance. Okay, so in this previous slide, it referred to MARR. This is something you need to know the definition for. Minimum attractive rate of return. It is the least amount of return that your company is going to do a project for. Sometimes it's also called the hurdle rate. And so there's a lot of things that helps your company to decide what % return they insist on in order to move forward with the project. And probably the biggest thing that determines what your MARR is set at is how much it costs you to get money. Whether you're borrowing money from a bank, or you're selling stock on an exchange, or taking out bonds, there's a lot of different ways to get money, but each of them have costs. And so the WACC, the weighted average cost of capital, is expressed as a percentage, and it's how much your company pays to borrow money. So that's just one factor. And the MARR can also be affected by how many good projects you have available. So a company like Google, which is staffed by lots of really creative, hardworking people with many, many good ideas, maybe they're going to have a much higher threshold for what kind of return on investment they want before they bother going into a certain market. But a groceries stores are notorious for having low returns on investment because it's so competitive. In the grocery business, a return of 2 or 3% may be considered really great. So different companies have a different perspective of what kind, even if they're not borrowing the money, even if they're a cash-rich company, sometimes just the number of available ideas can affect what you're going to be focusing on. And this idea of opportunity cost also plays into it. Opportunity cost is defined as the value of the next best option that you didn't do. So you're in class right now. You could be lots of other places. You could be working. You could be sleeping. You could be at the student center drinking a coffee. There's many different places you could be. So what's the next best place that you could be besides here? And what's the dollar value associated with that? So maybe your leisure time is worth $5 an hour. So maybe you're paying in opportunity cost terms $5 an hour to be in this class. Maybe you could be working at $25 an hour if you weren't here. So in that viewpoint, then the opportunity cost of being in this class is $25 an hour. So in the case of projects, if you spend money on one project, you can't spend it on other things. You can only spend $1 a single time unless you're like the government or somebody. But in most cases, if you're a private company, that dollar can only be spent one time, and it means you can't spend it on something else. Another thing that is going to determine what sort of return your company demands is how risky projects are and how complicated they are to administer. Depositing money in a bank is a very easy operation. Once you put the money in the bank, you walk away, and then the interest checks will come to you. So that 10% and 14% example, yeah, you do that when all you have to do is put the money in the bank. But what if to get that extra difference, you had to manage a whole apartment complex? I'm not so sure that I'd want to take on all that responsibility of managing an apartment complex and collecting rent, taking people's phone calls that their plumbing's backed up in the middle of the night. So the nuisance and the amount of time that it costs to administer projects is a factor that companies take into effect. And then organization types. Public entities like municipal governments and nonprofits generally will have a much lower MARR, much lower minimum acceptable rate of return than for-profit private corporations. And we're going to continue talking about the difference between those types of organizations later on. The money comes from a variety of places. Equity refers to stocks, or when a company owner is putting money from their personal finances into the business that they own. If you own stock, that means that you're a part owner of a company. So my son has an account, it's like a college savings account, and he owns shares in McDonald's, and never gets tired of me reminding him that he partly owns McDonald's. He thinks that's amazing. I don't have the heart to tell him that it's like 1/1,000,000,000th of McDonald's that he owns. It's a tiny fraction of the company, but by owning stock, you essentially are claiming ownership over their future revenues. That's why people are willing to pay for stock, is you're a part owner of the company's revenues. Debt, on the other hand, you're not a part owner of a company when you loan money. It's just that you have the right to recover the money that has been loaned at a certain pre-specified interest rate. And so those are borrowed funds for a variety of things like mortgages, bonds, loans, and so on. That's referred to as debt financing. So the rule is that the rate of return, ROR, for a project should be greater than or equal to the minimum acceptable rate of return. Remember, MARR is kind of like a policy decision, and your MARR should never be less than how much you actually pay to receive capital. So the weighted average cost of capital is how much your company has to spend in order to raise funds. Any questions about these definitions? So let's go back to opportunity cost. It's the value of the second best option. Another way of thinking about it in quantitative terms is it's the largest rate of return that was foregone due to a lack of capital funds. And so let's go back to this figure. Let's go back to this graph. We couldn't do project F and G. We didn't have enough money to do project F and G. And so our opportunity cost in that case is 16% in the case of project F. So let's use this as an illustration. Let's say that your company has as its policy that all projects have to earn 10% or more return on investment. Project A wasn't funded because you couldn't raise enough money to do it. And it was going to have a return on investment of 13%. Project B has 15%. So you choose the one that has the higher return on investment, and therefore your opportunity cost is going to be the project that you couldn't fund. And so you have an opportunity cost of 13% because it's the foregone opportunity. So there's both social ways of thinking about opportunity cost and specific quantitative ways to assess it. Okay, so with those definitions in mind, I'm going to ask you to take a look at a few things on this in-class exercise. There are two tables on this in-class exercise of information that I think probably most of you have never seen before. So I haven't told you about them today, but I want you to try and figure it out based on some of the abbreviations that are used, based on trends in the data. So try to think critically and analyze. You can talk with your classmate, but try and figure out what is the interpretation of these two tables, and then there are supporting questions that ask about those tables. We're all in agreement that projects A, C, D, and E are the ones that should be funded, right? And we should reject project B and F, the rule being that the borrowing costs was greater than the return. So anytime the borrowing costs is greater than the return, say no to that alternative. All right? And then here's the calculations for the weighted average cost of capital. You're borrowing 25% of the amount you need at a rate of 6.5% interest. 45% of what you need is at 4.5%, and then the balance is 30%. You have to pay 7.8 for that. So overall, the weighted cost of capital, 5.99% is how much you're going to have to pay. And there are, I think, one or two homework problems that are essentially the same thing. It's just a weighted average that you'll need to calculate. Any questions on the first page? Let's talk about the back side of the paper just briefly. Remember, on the earlier slide, there's the idea that there's two types of investments, equity investments and debt investments. Here's a list of companies, and each of these companies does offer stocks that can be purchased. And so if you want to be a shareholder of the company, you can invest in the company that way. Of course, the company could always issue more shares, and it could dilute the value of your ownership. So generally, stocks are thought of as being a little bit unpredictable. Maybe it's kind of a little bit more risky than bonds. This is a list of bonds. And this I took from the NASDAQ Dubai website a couple of months ago. It was listing all of the bonds that were available for sale on the Dubai stock market. So let's look through some of these things and try and decode it and talk about some trends. First of all, the date that's listed. You'll notice that all of these dates are in the future. And what they are is those are the dates that the bonds are finished. And so the way it works is that when a company is selling bonds, people line up to purchase them. And so if you wanted to invest in one of these bonds, you would pay the money, and then the company says, they'll pay you interest periodically. Typically it's every quarter. So they would give you an interest payment every quarter, and then they would give you the principal back at the end. And so that's what this date that's listed here is, when you get your principal back, the original amount that you loaned to the company. So that's the interpretation of the date. The question about the 3 letters in the code, I think probably most people were recognizing that these are related to currencies. And so USD stands for US dollars. What's GBP? Great Britain pound. EUR, euro. NZD, New Zealand dollar. CNY, Chinese yuan. Yeah. So those are the currencies that the bonds are denominated in. And it's pretty complicated because the rate of exchange could be changing at the same time that the value of your bond is itself fluctuating. And so a lot of times what people will do is they'll buy bonds in whatever currency, the currency of where they live or where most of their assets or debts are held, just to avoid currency risk. Okay, why does a single company, for example, Emirates NBD, which is a bank, the National Bank of Dubai, why does Emirates have so many different interest rates? So, for instance, they have some of their bonds are priced at this interest rate that's shown here. Some of their bonds are 1.75%, and some of the bonds are paying 6%. So what would you rather have? Would you rather have a bond that's paying 1.7% or one that's paying 6%? Well, all things being equal, it's better to earn 6% interest than 1% interest, but all things aren't equal. If you look over here in the price column, you'll notice that the bonds that pay 6% are more expensive. You would have to pay $104.92 to buy the bond, compared to one that's only paying 1.75%, then you only have to pay $94 to buy that bond. So there's a difference between the coupon rate, which is the interest rate that's on the face of the bond, and the yield of the bond. Like how much you actually earn on your investment depends on 2 things. It depends on the price that you paid for the bond and also the interest rate that it pays. And we're going to come back to this and later on in the semester and do some more specific focused work on correctly valuing bonds and finding out how much you should pay today for the future returns that a bond is going to provide. But a cash flow diagram for a bond looks a little bit like this. All right. So from your perspective, here's time. Time marches on. So you give the money to the person you're buying the bond from. You pay the money to the company. Then every quarter, they give you a little interest payment. And then at the end of the period, they give you your interest payment and the principal, the same amount that you were earning before. So what we're going to be doing later on is we're going to say, how much should you pay now? What is the present value of a bond you should be willing to pay? You know, like this interest over time, what is it worth? Because you need to look at inflation. You need to look at the other things that you could be doing with your money besides buying a bond. And so opportunity cost comes into play here, where you're setting your own personal minimum attractive rate of return. You're going to be trying to determine the appropriate price that you should pay for a bond to know whether or not the market is overvaluing or undervaluing a bond. So discounting is the process of taking all of this money in the future and moving it to the present, 1 year at a time. Any questions related to the backside of this paper and the interpretation of the data? The important thing to know, the trend here is that for now you need to know the things that pay a higher interest rate, it's called the coupon rate of the bond, you have to pay a higher price. there's a secondary market for bonds. You don't have to wait until the end of the bond's life to get your money back if you don't want to. You can sell the bond to someone else. And that's why these prices are changing, is usually when a bond is first sold, they try and make the price $100 per bond. But if, let's say that when the 6% bond was originally sold, interest rates were high. But then interest rates went down. So interest rates going down would make this 6% bond more valuable because you can't get a 6% bond anymore. That's why people are willing to pay this high amount for it. That's why it's worth $104, even though the person originally only paid $100 for it. It's because nowadays you can't get a bond that's paying 6%, and so the value of the bond kind of goes the opposite direction of interest rates in general. And so the opposite of that is also true. Let's say that you took all of your savings nowadays when interest rates are low in our current economy. Let's say that you bought one of these bonds that's only paying 1% interest. And now people start selling other bonds that are worth 5%, paying 6%, 7%. What that does is it makes the thing that you had already bought worth a lot less. You still keep getting the interest rate. You know, they're still going to pay you your 1% and you'll get your principal back at the end of the bond, but your bond is less valuable because everyone else is investing in other things at higher interest rates. And so nobody on the secondary market is going to want your lousy 1% bond when you could buy a 6% bond. And so that's why the interest rate changing affects the price to go higher or less than the 100, which was the original sales price. Yeah. Good question. So it's in the indicated currency. So $100, 100 euro, 100 pounds, and so on. Yeah. Okay, that's it for today. I hope you have a great Labor Day. I'll see you on Wednesday.